Hey guys, hope you're doing great. It's October and this is the time of year that I'm sitting down thinking about the outlook for next year. And what I want to explain to you today is how all these fancy organizations come up with an outlook, or how they come out with a prediction and what it means. And the biggest secret working in investment markets and financial markets over so many years is that forecasts are built on nothing but guesswork. It's all guesswork. These organizations sit down at about October, November, and they look at recent history. They look at past history. And in the Sydney property market, what they'll do is they'll look at price growth in the city as an average from 2009 to 2016. They'll look at recent history, right? So when I say guesswork, it's not out of thin air. It is based on what we have seen, but it is based on the past. It's not based on the future. And from 2009 to 2016, the market has been extremely strong, not just in Sydney, but all around the world. In Toronto, in San Francisco, in New York, in London, in Hong Kong, and in parts of China and Singapore. And Sydney is no exception because governments around the world have been slashing interest rates. And that's likely to remain the case in 2017. We might start to hear about rates starting to go up in different parts of the world, probably not in Europe, but in the US definitely. But that won't have a huge impact to what we've seen, the environment that we've seen since 2009. So that's what they'll do. They'll go from 2009 to 2016. They'll take an average that might be close to about 8%. They'll go back a bit further, maybe 10 years back, and they'll see what happened in prior cycles. The really intelligent ones will go back to the 70s and 80s and see what happened on similar cycles. But most of them will come back at an average growth rate of what we've seen, which is probably somewhere between 6 to 8%. And that might be true. That might be a really good guess as to what we could see next year. You'll always have those that say the market's going to go up 30% and those that say the market's going to fall 50%. They're the extremes. The newspapers tend to report on the extremes at the bottom, but most of the financial community, the really smart people, the intelligent people, will come out with estimates probably at around that rate. But the really smart investors are looking for all-weather scenarios. They're not just looking for property that can do well when the market goes up. They're looking for property that can do well when the market comes down. And some of you might be thinking, how can you do well when the market comes down? This is what an all-weather investor does. An all-weather investor looks for a business that can trade well in spring, summer, autumn, and winter. An ice cream stand at the beach might have a roaring trade in summer, but in winter, when everybody's rugged up, nobody's coming and buying your ice creams. And it's the same with stocks. The best investors are buying stocks and businesses that can do well in boom times and recessions. Some businesses actually do better in recessions because they go out and they buy their competitors. They take them out of business. They know that they're struggling, but they drive them out. And when it comes to property, you need to start thinking about an all-weather approach. You know, when Google stock goes up, when Facebook stock goes up, when Apple stock goes up, what happens is a lot of investors start sacrificing on quality and they start looking for the next thing, the next stock that's going to be the next Google. Hey man, you should invest in this because it's going to be the next Facebook. And it doesn't. The quality of the top is very different to the quality at the bottom. And in a housing market, in a housing cycle, what usually happens is the good quality properties always move first. And then a whole bunch of investors focus on poor quality. The next suburb to move up, the next thing to re-rate. Oh, they're going to build a big mall, they're going to do this and that. And they tell themselves a story, but what they're really doing is they're buying a poor quality product. And a lot of you might not like this message because you may have gone out or you're considering buying a poor quality product, but it's the truth. And the truth is that when the market turns, nobody knows when it will turn and how it will turn, but I have a very high degree of certainty that at some point the market will slow down, the market can pull back, and the market could be vulnerable. It's not to say that it's in 2017, but in the next 5 years, at some point, the market will show its vulnerability. No market in the world, whether it's stocks, bonds, gold, oil, has moved in a straight line upwards. Markets always move in squiggly lines, and that squiggle goes up and it comes down. And when that happens, you need to make sure that you've invested in a business, in a stock, and in a property that's of high quality. High quality property actually can do better in periods where the market's coming down, because of a lot of investors chase quality, flight to safety. And if you want to know what high quality is, you should jump onto the EPG site. That's what we do as a business. We're talking to people, to investors, to developers, to a whole range of stakeholders every single day, so that we help investors determine what quality is. We have 26 steps that measure the quality of a property, and each step is explained, and we use each step. We don't just look for one thing, we look at a collective science of all these things put together. So, in a nutshell, 2017 is most likely going to be another year around the average of where we've been from 2009 to 2016. At some point there will be vulnerabilities. I'm not sure if they're going to be in the first quarter, second quarter, halfway. They might be in 2018, 2019, when supply starts to hit the market. That's what I'm focused on. Not necessarily the overall growth rate, but finding that all-weather investment, that all-weather quality type of asset that I can buy and not worry if the market's going up or the market's coming down. Last point, when you hear the Sydney market is going up by 6, 7, 8, 10%, just remember that's an average of every single property, which means there are ones that do better and ones that do worse. And if you want to grow your portfolio, if you want to be successful at this game, guess what? You don't want to be focused on the ones that do worse, the ones that are below average. You want to be focused on the ones that are consistently above average. And again, that's the high quality property. In strong markets, people sacrifice, and sometimes the worst property can go up more, but over the life of the cycle, over longer periods of time, it's the high quality that always wins out. Please, please, please do not forget that. Good luck in 2017, and remember to subscribe to the channel for more updates. I'm going to be providing a lot of updates and providing a lot of guides as to where the forecasts are coming out and where I think high quality investments are showing themselves. Good luck.